Namaskar friends, welcome to the channel JIV and CIV Made Simple. Today we are going to discuss our unit number 28 of AFM. Chapter name is derivative. So let's get started with our basic fact. So a simple idea with a big power. This is all derivative is all about. So we will see the objective, introduction, derivative market, who are the regulator of derivatives, types of derivative, important derivative product in the Indian financial market, and use of credit derivative for the risk management. So these are the topics which we are going to study in this particular chapter. So let's get started with the derivative. So derivative is a financial contract whose value comes from something else, right? It is a kind of financial contract whose value is derived from something else. Okay, something else means what? An underlying asset. So something else means whose value is derived from underlying asset. Underlying asset can be a stock, bond, commodities, foreign exchange rates, or interest rate. Okay, and people use derivative mainly to protect themselves from price swing. People use derivative to protect themselves from the price swing or price fluctuation. That is called hedging. So this price fluctuation or price swing is called hedging. Okay, this is the point. So first point, I told you that derivative is something whose value is derived from the underlying asset like a stock, bond, etc. And this is the purpose of derivative is to protect themselves from the price fluctuation. The Reserve Bank of India define a derivative as an instrument that is settled in future. Right, instrument which is settled in future. This is the key point. Instrument settled in future and whose value changes because of movement in the interest rate. Its value is derived from the change in the interest rate. Okay, change in the exchange rate or change in the credit rating or the security prices. The most important thing to remember is that derivative value depends on how the price of the underlying asset moves. So the value depends on the price movement of an underlying asset. This is the most important thing to remember. Okay. So you can think of derivative as a promise or a contract. The contract worth is not based on itself but on something else which is called underlying. What is the meaning of underlying asset? This is the something else like a stock, a bond, a commodity, currency or interest rate. Then I told you that value is derived. Value is derived, the derivative value that the derivative price follow the derivative that price follow or is linked to the price of the underlying asset. If the underlying asset goes up or down, derivative value usually moves also. So the key point is underlying asset. If underlying asset goes up or down, similarly, what the derivative value goes up and down also. Right. Then I told you the purpose of this derivative. Simple purpose is hedging. Right. The purpose of this derivative is hedging. Hedging means protecting against unwanted price change. For example, a farmer can lock in price today for wheat he will sell later. That is the example of hedging. Now let's talk about the regulatory definition. So RBI stressed 2 points. These instruments are settled in the future. I told you now, these instruments are settled in the future. That means there is a date when the contract will complete and their value change due to interest rate, exchange rate, credit event or security price. Right. So unlike buying a share today, mainly derivative are agreement that finish at a later date. Settlement can be by exchanging the actual asset or by paying the cash difference. Now we will look at the main types of derivative that we have. Right. Some basically main characteristics of derivative we are talking about. Let's discuss it. So basically, the derivative are often highly leveraged. This is the first point, which means a small amount of money can control a much larger value. So it simply means, a small amount of money, they can control a much larger value. So that is what I mean by saying it highly leveraged. What is the meaning of highly leveraged? Highly leveraged simply means that a small amount of money can control a much larger value. So that can make profit bigger and losses much bigger also. Right. That is the meaning of highly leveraged. Derivative are called highly leveraged, which means a small amount of money can control much larger value. And one more point is that many derivatives require little or no initial payment. They require little or no initial payment. Instead, you usually put up a small deposit or margin, or in some contract there are no payment until the settlement. Okay, so they require little or no initial investment, because it means you put up a small deposit or margin, or in some contract there is no payment until settlement. That is why leverage exists. Leverage means what? Your investment is very low and the value you get is very high. right? And you know, all derivative has a settlement on the future settlement date, which means a day when the contract finishes and it's settled off, either by exchanging the asset or by paying the cash difference. That is the point. So what are the functions of derivative? The first thing is the risk management. Risk management means what? Shifting risk from one party to another so that the business can protect themselves. Second is to improving the liquidity, which means they also help the market find the right price. Then third is the capital raising. So indirectly they can help to raise the capital by making financing and a structured product easier. Now the question is, who use derivative? Farmer, exporter, right? Then importer, bank, mutual fund, right? Then corporate treasury, speculators, arbitrageurs, each for different reason for protection, profit, or exploiting price difference. So what are the key terms which we have talked in this slide? First of all, highly leverage. Highly leverage means you control a big position with a small deposit. That is called high leverage. Right, that magnify both gain and losses. Second point is little or no investment, which means unlike buying a stock outright, derivative often a very small margin or sometimes nothing at all. Then we have settlement at a future date. I think you know it. Every derivative has an end date. That is when you and the other party must deliver the asset or settle the cash difference. Risk management is there. Okay, obviously derivative is quite a hedging tool. Okay, so derivative lets someone transfer their risk. Liquidity management is there. More trader in the derivative market make it easier to buy or sell underlying asset quickly. Capital raising, which means by managing risk and by offering a structured product, derivative can make funding easier or cheaper for the company. Market depth, with more player and more order at different price level, market become deeper. Right, market become deeper and more stable in the normal time. Right, that is called market depth. With more player and more order at different price level, market become deeper and more stable in the normal time. Now the question is, who are the user of the derivative? Very important. Let's talk about it. User of derivative. So hedger. Hedger is one user. Hedger means what? Hedger means farmer, right? Importer, exporter, right? Corporations. These are called hedger. They are called hedgers. So they are the user of derivative. Why they use derivative? To protect against the price movement, right? They use derivative to protect against the price movement. That is one important point. Second is the speculators. Speculators means what? Trader and investor. Speculators means trader and investor, right? So how they use derivative? So hedger used to protect against the price movement. That is focus on protection against the price movement. Speculators, they are trader or investor. They use derivative to try to profit from the price change, right? They want profit. They want profit from price change. That is a speculator. Okay. So a speculator means they want profit from the price change. Okay, that is called a speculator. Third, we have arbitrager. So what is the meaning of arbitrager? Arbitrager means to exploit price difference across market and keep price aligned. So arbitrager, what they do? They exploit the price difference. Also, we have key stakeholder like financial institution and banks are there. So to manage interest rate, currency and credit risk, financial institution is there. Portfolio managers and mutual fund are there to protect portfolio or to adjust exposure. Remember these key points. So derivative are highly leveraged. They often need little or no initial payment. Settlement happen in the future. Main function includes hedging the risk, improving liquidity, supporting capital raising, and increasing the market depth. Main user are hedger, speculator, arbitrager, bank, and fund. Now friends, let's talk about the where do derivative trade? Yes, where do derivative trade? Where do trading happen? So there is something called OTC. OTC means over the counter derivative. So these are the contract traded directly between two parties, right? Traded between two parties, right? These deals are flexible. You can see na word written here. These deals are quite flexible. These deals are flexible. Okay, the size, the terms, the maturity, they are agreed between the two sides. The contract terms like size, maturity, they are mutually agreed. And one more point is that they are not standardized. Okay, so because they are custom, counterparty risk is higher. Yes, since these deals are custom, so which kind of risk is higher? Counterparty risk is quite higher. Okay, so this is the point, that is called OTC derivative, over the counter derivative. Then the second type we have is called exchange traded derivative, or we call it ETD. What does it mean? So basically these are bought and sold on an exchange with standardized contract term. So there is something called a standardized contract term, and these kinds of derivative are bought and sold on exchange with a standardized contract term. Which means when I say standardized contract term, it means the size, their expiry, their tick value, everything is standardized, everything is as per the standard, right? On one hand, OTC derivative were just like customizable, right? While exchange traded derivative are something standards. Okay, trade on exchange need initial margin and then daily margin adjustment. So first of all, you require initial margin, and then we have variable margin account. Okay, so losses or gain are settled as the market move. Exchange use a clearing house which reduces counterparty risk and add transparency. So exchange, what exchange does Exchange use a clearing house. Exchange use a clearing house, and what is the role of clearing house? The clearing house reduces counterparty risk and add the transparency. In the case of OTC, there was nothing like clearing house. So that's why counterparty risk is higher in this case. In India, markets and regulations are closely watched by bodies like SEBI and RBI, and trade happen on the regulated exchange, right? Please remember it. Now friends, the next point is, what are the things which we have discussed? First point about hedger, trader, speculator, OTC. OTC means over the counter, which means custom deal done between two parties, right? The pros is that they are quite flexible. The cons is that less transparent, higher counterparty risk is there. Then we told you about exchange traded derivative, which are standardized contract on organized exchange. The pros is that quite transparent, reduces risk. The cons is that less flexibility, because everything is standard, so flexibility is not there, right? So these are the points. Now friends, what are the points? I think it is clear now who are the regulator we have just discussed. Now friends, who watches over the derivative in India? So the Reserve Bank of India, right? The Reserve Bank of India regulate derivative tied to the interest rate, right? Interest rate, foreign currency and credit derivative, right? The Security and Exchange Board of India, that is called the SEBI. SEBI oversees the stock market derivative, right? And after merging with the Forward Market Commission in 2015, SEBI also look after the commodity future, right? So in 2015 there was a merger with the Forward Market Commission. Okay, so they also look over the commodity future. Now let's understand two basic type of contract. First is called forward, second is called future. So if we talk about the forward as private deal, right? Forward are just like a private deal. Two parties agree together to buy or sell an asset at a set price on a specific future date. So we're talking to the context of forward. Okay, so what forward is all about? These are like private deal. So two parties are there. Okay, what they are doing, they agreed today. Today they agree that I will buy or I will sell an asset at a set price on a specific future date. They agree to buy or sell an asset at a set price at a specific future date, and these are called OTC contract. Forward as OTC. OTC means over the counter contract. So the size, the date, the terms, they are decided between the party. They are mutually agreed term. And forward are great for locking a price and avoiding sudden loss or liquidity problem. So you can lock a price, and you can avoid, right? And you can avoid sudden loss or liquidity problem. For example, a company that will receive dollar in 3 months can lock a rupee dollar rate today. But forward are binding. They must be fully executed. This is a kind of binding. They have credit risk, right? They have credit risk, means other side might not pay, and they have also market risk. So the question can be asked that forward are exposed to what kind of risk? So credit and market risk are there, and forward are commonly used in the forex business, forex transaction. So I hope the concept regarding forward is crystal clear. Now let's move to the futures. So futures on the other hand are exchange traded. Futures are exchange traded. What is the meaning of exchange traded? It means the contract terms, which means the size, the expiry, everything is standardized. Everything is standardized, right? And trade go through an exchange and clearing house. So we have an exchange and also we have the clearing house, right? Through which the trade go through. And to trade future, you pay an initial margin. Yes, if you want to trade future, you have to pay initial margin. You have to pay, right? And gain or loss are settled daily. That is called mark to market. Here you will see the term. That is the mark to market. Mark to my MTM. MTM means they are daily settled. Gains and loss are daily settled. Because the clearing house guarantee the trade, futures have a lower counterpart. So if I ask you out of forward and future, which has a lower counterparty risk? So remember, in the case of forward, I told you, since it is an OTC product, so counterparty risk is there, and this future is not an OTC product, right? It is exchange traded product, so counterparty risk is less, and this is more liquid and are easier to buy and sell for expiry. So RBI, SEBI, forward contract, OTC. Why we use forward? To lock the price, to protect future cash flow, to avoid sudden market changes. What are the risk of forward? So counterparty risk, market risk, liquidity risk are there in the case of forward. Future contract, I told you, these are standardized, promise to buy or sell at a future date. Then I told you about initial margin. Initial margin means a small deposit required to open a future position. Clearing house is the middleman that guarantees exchange trade, reduce the chance that a counterparty will fail. So remember the keywords. Let me just write it down. What are the keywords which we have just gone through? Please keep these keywords in the mind. That will help you remember this forward and future. So let me write it down. If we talk about forward, just remember OTC. Just remember flexible. Just remember executed, must be executed. Just remember credit risk. Right. If we talk about the future, right. So future, they are exchange traded product. They are standardized. They are, they require margin. They require margin plus daily settlement, right? And there is a clearing house. There is a clearing house. Okay. These are the key points. So friends, I hope these 2 points are clear what we have discussed just now. Now let's move forward and see the next slide. Yes, there are some formula, right? So swap and okay, let's look at this formula. So question is, how are future price? Let's look at the future pricing. So think of the future price as the spot price today plus the cost of holding the asset under delivery and until delivery. This include financing, storage, insurance, transport, minus any income the asset give while you hold it, like dividend. Or what kind of income can you get from the asset? You can get dividend, or you can get coupon. You have to subtract any income that you get from the asset, and you have to add any basically the cost of holding the asset until delivery, financing cost, storage cost, insurance cost, transport cost. Okay, so a simple formula is like this: future price is equal to a spot price plus cost minus income. You can see asking is a spot price plus cost minus income. Now let's move to the swap. So what is the meaning of swap? Let's understand. Swap is a private agreement where two parties exchange cash flow. So it's a private agreement. Two parties exchange cash flow. On what basis they exchange cash flow? They based on a pre-agreed formula. There is a pre-arranged formula. The swap is applied to a notional principle. Remember, swap is always applied to a notional principle. Very, very important. So what is the meaning of this notional principle? It means reference amount. Notional principle means reference amount. Okay, which means on which payments are calculated on. Though that principle usually does not change hand, right? So what I want to tell you, we are talking about swap. Swap is a private agreement where two parties exchange cash flow based on a pre-arranged formula. The formula is pre-agreed. Swap is applied on notional principle. Notional principle is a reference amount, right? Means the payment are calculated on the reference amount, though that principle usually does not change hand. Now, common swap include interest rate swap, which means we swap the fixed payment for a floating rate payment. We will discuss in detail. right? So in this case, what happened in the case of IRS? IRS means interest rate swap. We exchange fixed rate cash flow for floating rate cash flow. And then second type we have is called currency swap. In the case of currency swap, we exchange interest and sometimes principal in different currency. In case of currency swap, what we do? We exchange interest and we exchange the principal. We exchange interest, we exchange the principal, right, in different currencies. So swap are typically used to manage ongoing cash flow risk. So swap are typically used to manage ongoing cash flow risk. For example, a company with a variable rate loan can swap to a fixed rate payment to gain certainty. Suppose there is a company, they have a variable rate loan. They can swap it to the fixed rate payment to gain certainty. So friends, what we have discussed in this slide, we started with future pricing. How to make the price of the future? Very simple. Future price minus a spot price gives you the current market price of the asset. Cost, here you will see some cost. Cost means money you must spend to hold the asset until future delivery. Obviously you have to spend some money to hold the asset, like a storage cost is there, like basically financing interest cost, storage fee, insurance cost, transport cost. And the income is the cash that the asset give while you hold it, like dividend and coupon. So simple pricing formula is there. Future price is equal to a spot price. You add the cost which is incurred and you subtract the income, right? Easy way to remember the carry area, right? Then so first of all, you take the spot price, you add the cost you incurred, you subtract the income, that will give you the future price. Now swap is a bilateral deal where two parties exchange a stream of payment. So two parties exchange cash flow, a stream of payment, that is called swap. Then we talk about the notional principal, which is the reference amount used to calculate payment, often never exchange. We talked about the interest rate swap example, like party A. Two example I've given you. Suppose the party A is there. So this party A, they pay fixed interest. Party A pay fixed interest, while party B pay floating interest. Party B pay floating interest, right? So they net the difference periodically. I hope it is clear. Then we talk about the currency swap. So currency swap means what? Parties exchanges interest payment in different currency and sometimes swap principal amount at the start at the end, right? So remember the key points is, I hope it is clear now. Future pricing is equal to a spot plus carry minus income. Remember carry. Carry means cost minus income. Swaps cash flow between two parties using a notional amount. Main swap type are IRS, where in the case of IRS, just remember, if we talk about IRS, here fixed is swap with the floating. Fixed is swap with the floating. And the second, this is called interest rate swap. And the second kind of swap we have is called currency swap, where what happened? Where we make payment in different currency. We make payment in different currency. And swap are used to transform cash flow and manage long-term financing risk. Okay, so let's discuss the different types of swap in detail. Okay, IRS swap, currency swap. Okay, before that, just an overview of this. So interest rate swap, what happened? That two parties are there. They agree to swap interest payment. One side pay a fixed rate and receive a floating rate. The actual loan principal usually does not change hand. They just exchange the interest rate difference. What is the meaning of basis swap? Basis swap means what? Both sides play floating rate, but the floating benchmark are different. Now why to use swap? Why we use swap? Because they create synthetic fixed or floating assets and liability. That means you can mimic a different kind of loan or investment without actually changing the original one, right? That is the point. That is the mimicking. You can mimic different kinds of loan or investment without actually changing the original one. And the second advantage is their hedging. Hedge against the bad market move, hedge against the adverse market movement, right? Swap lock your future cash flow into a predictable pattern. Then help in the asset liability management. Yes, they also help in the asset liability management. Swap are helpful in the ALM. So the bank and treasury matches what they pay with what they receive, and they reduce the funding cost, which means some party get cheaper rate in one market. Swapping let both sides benefit from comparative advantage. So a quick note about India is given here, that bank can run swap book that include a rupee leg. Okay, so which means one side of the swap is INR, that is called rupee leg. So if the swap has no rupee leg, without a rupee leg, that means purely foreign currency, Indian bank cover that exposure, right, back to back. So we are talking about the rupee leg. Rupee leg means one side of the swap is INR. If the swap has no rupee leg, purely foreign currency, Indian bank usually cover that exposure back to back with an, this is called back to back basis, with an overseas bank, effectively entering and offsetting swap abroad, so they are no left with unhedged foreign exchange. So here are some terms which we have gone through. First one is the IRS. IRS means interest rate swap. Imagine two friends are there. One has a loan with changing interest rate. Other has a loan with steady interest rate. They agree to swap payment so that it gives the type of payment that they prefer. Then currency swap is what? Think of swapping monthly pocket money in rupee for dollar, plus swapping the actual amount at the start and the finish. Company do this when they need cash in different currency. Then basis swap means both pay floating rate, but those floating rate come from different yardstick. Swapping help if your income and expense float on different benchmark. Benchmark are different, then basis swap will happen. Like one is linked to LIBOR, other is linked to SOFR or any other benchmark rate. Then hedging with swap, very very important. Before that, synthetic position. What is the meaning of this term synthetic position? It means that using a swap to act like you have a fixed loan where you actually don't. It's like a workaround that changes cash flow behavior without moving the original debt. Then we have hedging with the swap, which means swap make future payment predictable. This lower the chance of surprise cost, right? ALM means asset liability management. Means bank match the cash they get from an asset with that they owe, right? Swap help align those things also. Reduce the funding cost, which means suppose company A is there, they can borrow cheaper in market X. They can borrow cheap in market X, and company B can borrow cheap in market Y. So they can swap obligations so that each benefit from the cheaper rate. Then we have back to back cover, which means if the bank write a foreign currency swap for a client, it may immediately enter the opposite swap with a foreign bank, so it does not keep the foreign currency risk itself, right? So remember the keywords. IRS, whenever you see, it means fixed for floating, right? Second word, currency swap, you swap the cash flow in different currency. Basis swap, you swap cash flow, you swap currency, basically different floating rate legs are different, right? Then uses of this these swaps is to create synthetic position, hedging, manage ALM, reduce funding cost. And Indian rule is that bank can have INR leg. Swapping without INR are usually covered back to back with an overseas bank. Now let's discuss about options. Let's talk about the options. What is options and its different types? So friends, option is a contract that give the buyer the right but not the obligation to buy or sell a specific quantity of an underlying asset at a set strike price. So we are talking about the option. Option is a contract that give the buyer the right but not the obligation. This is the keyword. They give the right but they don't give the obligation, right, to buy or sell a specific quantity of an underlying asset at a set strike price. Okay, on or before a fixed expiration date. Remember the key point. It gives the buyer the right but not the obligation at a specific strike price before expiration date. There are two things here, a call option and a put option. So call means the right to buy and put means the right to sell. An option can be written on physical goods like wheat, gold or oil. You can see this can be physical commodity or it can be financial instrument like a stock and bonds. And buyer pays a premium. Whoever is the option buyer, he pays a premium, right? He pays a premium, which means that that is the price for having that right. Okay, the seller, which means the writer, receive the premium but takes on the obligation if the buyer, right? So what I want to tell you, that the seller, the buyer pay a premium, that is the price for having that right. The seller means the writer receive the premium but takes on the obligation if the buyer choose to exercise. And option differ by exercise style. European option is there. What happened in the European option? European option can be exercised. One trick to remember it, E for European and E for expiry. So this way you can remember it. So European option can only be exercised on the expiration date. What about American option? American option can be exercised anytime before the expiry. So A for American, A for any. Just remember one thing, you can easily remember the other. European option, E for European, E for expiry. So they can be exercised at the time of expiry only. And an American option can be exercised anytime before the expiry. That's the difference. Right, remember buying an option gives choice and limited downside. That is the premium paid. Selling an option give income but can create obligation and a risk. So what are the points I told you? Options means, think of it like booking fee for a future choice. You pay now to keep the choice to buy or sell later. Then call option means you gives you the right to buy at the strike price, right? Under the call option, you get the right to buy at the strike price. Use it when you expect the price to go up. You are expecting that price will go up, so exercise the call option. Call option means you get the right to buy, right? And put option, it gives you the right to sell at the strike price. So use it when you see that price is going down. You just apply the put option. Underlying asset means these are the thing that option is based on. It can be commodity, stock, bond, currency, index, etc. Strike price is the pre-agreed price at which the buyer can buy or sell or put. Expiration and exercise date is the last day that option can be used. Premium is upfront payment the buyer give the seller for this right. The upfront payment that is the buyer give is called premium. Then one word you will see here, so-called intrinsic versus time value. So basically part of the premium is immediate worth if exercised now, that is called intrinsic, and the rest is time value, means what you pay for chance that the option will become more valuable before expiry. So whatever payment you do, whatever premium you pay for the option, it goes toward two things. First is the intrinsic value. What is the meaning of intrinsic value? That means that part of the payment is immediate worth. That means it is immediate worthy. That is called intrinsic. Plus it also goes toward the rest is the time value. What is the meaning of time value? Time value means what you pay for the chance that the option will become more valuable before expiry. Then we have the next word that is called settlement. Settlement means if you exercise it, settlement may be by delivering the asset physical or by paying the cash difference. So remember one keywords that you must keep in the mind, which is very helpful to understand it. Remember, option give you the right but not the obligation. Remember this keyword. You have been given right. Either you exercise it or not. There is no obligation. You may exercise it or you may not exercise it. Call means right to buy. Put means right to sell. Premium, who pay premium? Premium is paid by the buyer, option buyer, and the seller receive it. The strike price is the agreed price. These keywords you must know. The strike price means what? Means the agreed price, the price that we agreed. And expiration is the last chance to exercise. European and American option, remember, E for European, E for expiry, which means such kind of option which can be exercised only on expiry, European option. And American option means any kind of option that can be exercised before expiry until expiry are called American option. And premium has two parts. One is called intrinsic value, and the second part is called time value, right? And buyer maximum loss is the premium. Seller risk can be much larger, right? I hope these 2 points are clear. Yes. Now let's look at these types of option: call option and put option. Let's understand it. Now friends, American option give the buyer right to exercise at any time. There are two basic option type: call, which give the buyer the right to buy the underlying asset at the strike price, and the seller must sell if it is exercised. The seller is obligated to sell if it is exercised. And the put option give the buyer the right to sell the underlying asset at the strike price. The seller is obligated to buy if exercised. Right? Remember these keywords. Now friends, switching to the interest rate, we have something called FRA. This question is most frequently asked. That's called forward rate agreement. So what it is basically, it is a forward contract that lock an interest rate for future period. So what it does, it lock interest rate for the future period. Till now we were locking the price. Now we are locking the interest rate. That's the difference. In FRA, one party agreed to pay a fixed interest rate that is called the fixed leg. Fixed leg means one party agreed to pay the fixed interest rate, right? And the other party pays the floating interest rate that is called the floating leg. Usually he want to pay through the 3-month MIBOR, Mumbai Interbank offer rate, right? So both calculated on the notional principle. Both calculated on a notional principle. Remember these keywords. So in FRA, we have what? We have on one side fixed interest, fixed rate, right? One party agreed to pay a fixed rate, another party agreed to pay a floating rate. Both calculated on notional principle. The contract settled the difference so that the neither party actually exchange the full principal. They only exchange the net cash difference. So let me give you some example of it. FRA. So FRA is a forward contract specifically for interest rate. Here you will see the word notional principle. You know what is the meaning of notional principle? It means a reference amount used to calculate payment. It is not usually, the notional principle is not exchange. It is just a reference amount. Okay. and only the interest difference is settled in the cash. So think about it like a reference amount. Okay, fixed leg and floating leg. Fixed leg means the agreed fixed interest rate that one party will pay. Floating leg means a variable market rate the other party will pay. It will be known only when the period start, right? So how FRA settlement work? At the start of the interest period, the contract compare the locked fixed rate and the market floating rate. The party who owe more pay the net difference to the other. Why to use FRA? Because to lock the borrowing cost or to protect future interest income. So company and bank avoid surprises. So let me show you that how FRA work. Right. Let me show you. So this is party A. This is party B. Right. There is an exchange going on. Okay. And this one is the fixed rate. This one is the fixed rate, and this one is the floating rate. Okay, floating rate. It's like floating rate can be 3-month MIBOR. Okay, and then we have a notional rate. So this notional rate, it is reference rate. So remember, call. Whenever you see this word call means buy option. Sell means put option. Put means right to sell, right? Then call option, sorry, put means sell option. Difference. Now, buyer cost is a premium, seller receive premium but may have obligation. FRA is a forward contract that lock a future interest rate. Notional is a reference amount, right? This is the point. Now let me give you one example to illustrate how this FRA work like. So friends, suppose a company want to borrow 1 crore for 6 months. A company want to borrow 1 crore for 6 months, right? But the loan start 3 months from now. It will not start immediately. It will start 3 months from now. Like suppose this is September, so the loan will start from December, right? December. Now suppose a company they want to borrow 1 crore for 6 months. To lock in the borrowing cost, they enter in 3 versus 9 FRA at 6.5%, right? So this means the company lock a 6.5% interest rate for 3-month period starting 3 months later. Now, so what happens? Suppose the benchmark rate rises to 7%. The company will benefit because it is paid the difference of 0.5%. And if the rate falls to 6.25%, then the company pay the difference of 0.25%. To say anything can happen because we are dealing with floating interest rate. Currently it is 6.5, but suppose the benchmark rate rises to 7%. So since it rises to the 7%, the company has agreed to borrow 1 crore for 6 months. Right, the loan starts 6 months from now, 3 months from now. So this is written like 3 versus 9 FRA. So it means loan will start for 3 months and it will go to 6 months. The key takeaway is that FRA ensures that company's borrowing rate is effectively locked at 6.5% no matter how interest rate move in the market. If the interest rate goes up, right, then if the market benchmark rate goes up, the company will benefit. It is paid the difference of 0.5%, and if the market interest rate comes down, then company borrowing rate is effectively locked at 6.5%. So what are the key points about FRA? You must know that it is customizable, which means so someone may ask you, tell me whether FRA is OTC market product or exchange market product. So remember, FRA is an OTC market product. That's why it is quite customizable, right? Credit risk is there because credit risk is low, very less, because only interest difference are exchanged, not the full principal. That's why credit risk are very less. Full principal remain intact. Purpose is mainly used to hedge the short-term interest rate risk. And the settlement, the contract settle the interest difference on a notional principal at a future date. I think we have discussed these things. Right. So FRA in India can be illiquid. Remember, FRA in India can be illiquid, which means it may not be easy to sell or cancel before the settlement date. Despite that, they are very effective in locking in the interest rate. So you must know the notation of it. Last time question was asked regarding the notation. Okay. So let me explain the notation, how the FRA notation works. So FRA example, like company borrow 1 crore loan starting 3 months later for 6 months. So why we write it like 3 versus 9 FRA? Sometimes you will see written 3 into 9 FRA. This way also written. So remember, the first 3 indicate the month until the loan start. It indicates the month until the loan start. The first alphabet indicate the first letter indicate the month until the loan start. That means it will start from the third month. And 9 indicate the month until the loan in. Month until the loan in. So if I ask you what is the period of the loan, the period of the loan is 9 minus 3 is equal to 6 months. Suppose I say 4 into 7 FRA. It means the loan will FRA. The FRA will start. The loan will start from 4th month and it will continue till 7th month. So effectively the period is only 3 months. Right. Then we talked about the logged rate. There is a rate that we have logged at. Like in this case 6.5% rate we have logged at. If the market rate rises above 6.5%, the company receives the difference. And if the market rate fall below 6.5%, what happen in that case, the company pay the difference. Okay. Then customizable OTC contract, I told you, size, duration, start, end can be agreed between the party. Credit risk is there, illiquidity is there, right? So if someone asks you that whether principal is exchanged in the case of FRA, the answer is no. Principal is not exchanged. Only interest rate difference is exchanged. Purpose is to hedge the short-term risk. Example I have given you. Now, one more point is buyer and seller rules. Let's talk about it. So customizable, purpose, agreement, this thing we have discussed. Now buyer and seller role in the FRA. Let's talk about the buyer and seller role in that forward rate agreement. Right. In FRA, the buyer is usually a borrower who want to hedge against the rising interest rate. So why buyer is someone who borrow the FRA? He buy FRA to hedge against the rising interest rate. He anticipate that interest rate is going to rise, and he feel like it like that. So that is why he buy an FRA by paying some cost. Right. So by buying an FRA, they lock in the future borrowing rate. And the seller of the FRA is usually a lender who want to protect against the falling interest rate. Right. So he is worried about the falling interest rate. Buyer is worried about the rising interest rate. Right. So they receive the fixed rate if the market rate fall. The seller receive the fixed rate if the market rate fall. Okay. So FRA also help in asset liability management. How does it help in asset liability management? So that bank and company can lock in interest rate to manage the mismatch between their rate sensitive asset and liability. So bank have some asset that are quite rate sensitive. Bank have some asset that are quite rate sensitive liability. With reference to which rate? Interest rate. So some rate are rate sensitive asset, some risk are rate sensitive liability, right? So there is a mismatch between the rate sensitive asset and liability, basically making sure that what they earn and what they pay is predictable. Now let's switch our focus to the plain vanilla interest rate swap, that is called plain vanilla IRS. So this is the simplest type of interest rate swap. What happened here, one party agreed to pay a fixed rate and the other party agreed to pay a floating rate. So fixed rate is exchanged for a floating rate and vice versa. And again, payment are calculated on notional principle. Notional principle means the principal itself is not exchanged. This is the point. The payment is based on the notional principle. And one more point is that cash flow occur at a pre-agreed interval. Cash flow occur at a pre-agreed interval over the life of the swap. For example, quarterly or semi-annually payment. Now, what is the RBI guideline on IRS? RBI says that bank on use, which means bank can use IRS for their own balance sheet management or for market making activity. Second point, corporate hedging, which means bank can offer IRS to the corporate, helping them hedge their balance sheet exposure to the interest rate movement. So some words which we have spoken right now. So FRA buyer are the borrower who want to lock a future borrowing rate. They will benefit if the rate rise. FRA seller are the lender who want to lock lending rate, right? And who want to lock the lending rate. They will benefit if the rate fall. ALM rule is that it helps bank or company match the interest earned on asset with the interest paid on liability. They can easily match how much interest they have earned on asset, how much interest they have paid on liability. Right? Bank and financial institution can take help of it. Plain vanilla IRS means a basic interest rate swap. Right? It is a kind of basic interest rate swap. So fixed one is swapped for floating one. Is exchanged for floating rate. Notional principle, I told you, it is used to calculate the payment. Principal itself usually does not change hand. And Periodic payment interval. Swap settle periodically over the swap life. So you can understand it like this. Whatever point we have discussed here, FRA buyer is the borrower, and borrower is hedging against the rising rate. He don't want the high rising rate. Then FRA seller is the lender, and he don't want the rate to decrease, right? Falling rate. ALM means managing the rate sensitive asset and liability. Now let's look at this particular slide. Very, very important. So friends, let's go through some important RBI guideline and best practices for bank before engaging in market making or using the IRS. So there is something called, infrastructure and risk management system. Here you can see written here clearly, which means bank must have a strong system in place before doing market making. This means proper technology, risk check and monitoring tool. Then we have the benchmark rate. You know what is the meaning of this benchmark rate? Basically, the interest rate used as the benchmark must evolve naturally in the market and be widely accepted by the market participants. So what I want to tell you about benchmark rate, that interest rate used as the benchmark must evolve naturally in the market. Here is the keyword. Let me highlight it. They must evolve naturally in the market, right? And be widely accepted by the market participants. Next point we have is rate flexibility. What is the meaning of it? See, bank and corporate can choose any domestic money or any debt market rate. They can choose any domestic money, they can choose any debt market rate as the benchmark, as long as it is objective. Objective means not manipulated by anyone, as long as it is transparent, which means visible and understandable, as long as it is mutually acceptable, which means both party will agree or not. That is called rate flexibility, which means bank and corporate can choose any domestic money or debt market rate as the benchmark. They have flexibility. They are given flexibility to choose any rate. No restriction on notional principle. This thing I am repeating again and again. There is no limit. There is no minimum or maximum limit on the notional principle for an IRS. No tenor restriction, which means parties are free to choose any duration for the IRS. Capital requirement. So bank must maintain adequate capital while entering into FRA or IRS to cover the potential risk. So what we have talked just now, we started with the infrastructure and risk management. I told you before market making, bank need proper system. So when I say infrastructure, so they need three things. They need proper system, they need proper software, and they also need risk control, right? Risk control, it ensures that they can monitor and manage the exposure safely. Then we talk about the benchmark rate. The rate used to calculate the payment must be the market driven and must be accepted. Next, rate flexibility, which means the rate used to calculate the payment, that is the floating leg, must be market driven accepted. Parties can select the benchmark, but it must be objective, transparent and mutually acceptable. No notional limit is there, which means you can use any loan or reference amount to calculate interest difference, small or huge. No tenor limit. RS can be short term or long term. No RBI restriction on the duration term. Right. These are the point regarding the interest rate swap. So what I want to tell you that bank must have adequate infrastructure and risk system before market making. Benchmark rate must evolve naturally and be accepted by the market. Rate flexibility must be objective, transparent and mutually agreed. No restriction on the notional principle, no restriction on the tenor, and capital requirement, bank must hold capital for FRA and IRS exposure. Now, salient point of the interest rate swap, salient point of the IRS. Let's have a look. So basically IRS has a series of FRA. So you can think of IRS as a bundle of forward rate agreement, right? Each payment in the swap is like a small FRA settled at a future date. So it is a series of FRA. You can think of IRS like that. Then no exchange of notional principal. This thing is repeatable, that both FRA and IRS, in both of them, the notional principal, that is the reference amount used to calculate the interest, is not actually exchanged. Only the net interest difference changes hand. That is the point. Then then we have contract structure, which means an IRS is a contract between two parties who agree to exchange interest payment calculated on notional principal over a specific period or at a pre-agreed interval. That is how we define the IRS. Complete definition. Buying an IRS, the buyer of an IRS chooses to pay fixed interest rate and receive floating interest rate. So buying an IRS means what? You whenever you are buying, right? You mean it means you choose to pay fixed interest rate and receive floating interest rate. Suppose this is you. Think about it. This is you. You want fixed interest rate, right? Sorry, you will receive floating interest rate, and you want to pay fixed interest rate. That is when you buy an IRS. And this is usually done when the buyer expect that floating rate to fall. So that's why you converted the floating rate to fixed rate. Now, pricing quotation. So IRS price are usually quoted based on the fixed rate. Price are usually quoted based on the fixed rate. Okay, they remember it. And the fixed rate interest rate that the one the party agree to pay. Pricing quotation is based on the fixed interest rate. Pricing mechanism. The price of an IRS is determined by calculating the present value of all the future fixed and floating cash flow. Very, very important. We calculate the present value of all the future cash flow, then we will determine the price of an IRS. So what I told you that IRS is a series of FRA, which means each interval in a swap is like a small forward rate agreement for the interest payment. Then notional principal is never exchanged. Only the net difference in the interest is paid. Contract structure, I told you, two parties are there. Like they exchange fixed versus floating interest over the set interval using a notional principal in the base. So remember, the quotation of pricing is always done on the fixed rate. This is very, very important. Price quotation is always done on the fixed rate, and pricing means present value of all the future and floating cash flow. Now let's understand the interest rate option, especially caps and the floor. What is the meaning of cap? Whenever I say this word cap, just understand. Cap means, an interest rate option that limit your borrowing cost, right? So where the buyer limit interest. So basically interest rate option that limit the borrowing cost. Okay, by setting a maximum rate, that is called the cap. You set a maximum rate, that is called the cap, and you limit the borrowing cost. Okay, so if the interest rate on your loan rises above this ceiling, the cap seller pays you the difference on the notional principal. So there is a ceiling, there is a limit which has been maintained, and if the interest rate on your loan rises above this ceiling, cap seller pay you the difference on the notional principal. So cap limit your borrowing cost. Please remember it. It limits your borrowing cost by setting a maximum rate, that is called the cap. Means how much you can borrow, how much cost you can bear to borrow. That is what is limited by a cap. So in interest rate option, this is a kind of IRS that limit your borrowing cost. So I will give you one simple example to illustrate it. Let's have a look. Suppose there is a company which issued a bond. A company issued a bond worth rupees 100 crore at a floating rate of 6 month MIBOR plus 50 basis point. So you know about bond. So whenever company issue bond, what will happen? That we are investor, we want to purchase that bond. Company will take money from us, and company will give us interest rate in the form of coupon, and lastly at the fixed price at a time maturity, par value. You know it very well. So company issue a bond worth 100 crore, and the company invests this money at the fixed rate of 8%. So whatever money that company got by issuing the bond, they invest at 8%. Fine. Now interest is paid to the bondholder every 6 months, right? Biannually and half a yearly, and the bond mature in 5 years. So these data have been given. Now suppose the 6 month MIBOR rate rises above 7.5%. Think about it. The MIBOR rate rises above the 7.5%. What will happen? The borrower started earning a negative spread, right? The borrower will start making a negative spread. Meaning they earn less than 2.5% return on the investment. So if the 6 month MIBOR rises above 7.5%, so you think about it. MIBOR they have said 7.5% and plus 50 basis point, which means total it become 8%. Isn't it? So 6 month MIBOR rises above 8%, is basically 7.5%. The borrower will start earning negative. Right? Who is the borrower? The company is the borrower. The company will start earning negative. right? Meaning they earn less than 2.5% return on the investment, right? Earning less than 2.5% return. Okay, so to protect against this risk, the borrower buy a cap of 7%. What they do? They buy a cap at 7%. Okay, so this cap, this cap guarantee that minimum spread of 0.5% will be always be there, right? Minimum spread of 0.5% will always be there. Suppose they buy cap at 7%, so maximum interest rate that it can go is 7.5 because floating rate MIBOR plus 7.5. That is what the company has to pay to the bondholder, and they have invested at 8%. So this gap guarantee the minimum spread. Spread means what? Spread means your earning minus your earning cost minus borrowing cost. See, think about it. So think about it like this. This is your company, right? They are giving to the bondholder how much? They are giving to the bondholder at the MIBOR rate plus 0.5%, right? And they are taking from where? They are taking from they are taking they have invested the money, and since they have invested the money at 8% interest rate, they have invested at 8% interest rate. So suppose I have put a cap of 7%, so maximum it can go to 7.5%. 7.5% I have to spend. I have a company, and 8% I am earning. So what is our spread? The maximum spread that the minimum it can go is 8 minus 7.5 is equal to 0.5. So at least this must be maintained. That is the peculiarity. That is the utility of having a cap, right? It cannot go below 0.5%. And suppose the 6-month MIBOR exceeds 7%, right? 6-month MIBOR exceeds 7%. The cap seller compensate the borrower for the extra interest. So whoever is the cap seller, he will compensate for the difference. This is the point. Since he has bought a cap, so whoever company has bought cap from someone, whoever is the cap seller, he will compensate. Suppose I say that 6-month MIBOR will become 7.2, right? Now 7.2 plus 0.5 will become 7.7, and 8% is earning. How much is the spread? Is 0.3 is the spread. So the cap seller will provide the company 0.2% interest extra to compensate for the difference. And if the MIBOR is still below 7%, the borrower does not exercise the option, because this is the kind of option we have. It depends on me whether I want to exercise it or not. It is not compulsory. It's not an obligation. It's my right. I have paid for that right. Right? I hope it is clear. So in short, we can say cap work like an insurance against the rising interest rate for the borrower. So this example is the best example to understand this concept regarding the cap. Right? So cap means, cap means you set a minimum, you set a maximum interest rate that you will pay, right? And notional principal is the reference amount used to calculate interest rate difference. Floating rate loan, negative spread, buying a cap. So obviously you have to pay a premium. Whenever you buy a cap, you have to pay a premium. Company has to pay a premium. The purpose is to protect against the rising interest rate and ensure